And we have another special report on post-QE2 global financial markets.
So the Cup Kun Paul Gabel. How are you today?
Very good, thank you.
First question, the second round of the U.S. quantitative easing, better known as QE2, will be ending in June. What are the impacts on the world economy?
Yeah, that's the really big question today. I remember when I was young, people used to say that if something was a big question, it was a $64,000 question. Well, now maybe $64 trillion is perhaps a better way to measure it. We're really worried about the impact of this because if you look at the latest US GDP figures, they showed annualized GDP growth of about 1.8%, but actually we think that was distorted. If you look at the effects of consumer spending over Q4 and over Q1, then actually we think the adjusted GDP should perhaps be closer to something like 1% growth at the moment. So it's getting very close to stall speed. It's getting very close to going back into a recession. And we think that the minute you take away the support of all the liquidity and all the stimulus that the US markets had, then we expect another very deep recession. We think that 2008 may just have been a sideshow. We think that it could be far worse this time.
You're saying QE2 did not work at all?
We don't think it did. We think looking at the amount of money that was spent, and people tend to focus on the headline money. They tend to focus on the $2 trillion that was spent on top. They don't necessarily look at the $6 trillion that was focused on guaranteeing the Fannie Mae and the Freddie Mac debts. Bill Gross at PIMCO has been talking about how, although the visible US public debt is about $15 trillion, the off-balance sheet liabilities are more like $75 trillion. And that's a much, much bigger problem. And the US is going to have to face that right now. It may well not want to stop the quantitative easing. It might not want to stop the stimulus, but we believe it has to stop the stimulus because of the fact it's just not working anymore. The effects are getting watered down. They're getting less effective all the time. And what we think now is it's actually starting to get close to where it has a negative effect because the stimulus is going into counterproductive assets. It's increasing the price of oil. It's increasing the price of commodities. All that's happening now is input costs, input prices are getting pushed higher and higher.
What will happen when they stop the stimulus then?
Well, then we think the US economy will just collapse into a huge slowdown, into a massive recession. As I say, a far bigger recession than we saw in 2008. It may well be the biggest recession that the world has ever seen, and we think that it'll drag all the rest of the major economies into a huge recession with it. And we think that asset prices will get absolutely devastated when this happens. If you look at everything since 2009, all asset prices at the moment are largely influenced by the amount of liquidity that's in the market. So all this money that's flowed in, the $2 trillion from the TARP and the TALF programs, the $6 trillion from supporting Fannie and Freddie, all of that money has just pushed asset prices up. That's why we're seeing oil prices so high. It's why we're seeing food prices so high. It's even why we're seeing gold prices so high.
A new record, right?
Absolutely, new record, over 1,500. Yeah, that's right. And that's because the dollar is so weak and because there's so much liquidity, it's pushing the price of gold higher. But all assets are being pushed higher. So we don't think any assets are at the right price.
So obviously you are a pessimist.
Well, I suppose you'd say in the short term, yeah, because we think that there's a big problem and it hasn't been dealt with, and we think it's gonna rear its ugly head. In some ways, we're optimistic though, because we think that for Asia, it'll be a very painful period of adjustment, but we think that Asia will bounce back from this relatively quickly. So we're looking for Asia to do very well, maybe over the coming years, as we expect Asian competitiveness to really reinforce itself against the Western economies that are in debt.
And next, food and fuel inflation has been rising rapidly.
Yeah.
What does it mean to the world economy?
Well, again, this is purely because of the liquidity that's out there. All the stimulus is all flown into these sectors. Capital will go and hunt for the most effective return, and the highest return that you get is in assets like commodities that are priced at the margin, where a very small difference in supply or demand makes a huge difference to the price. So what we've seen is all this stimulus capital has flown in there. It's driven the prices up like crazy, and we think that when the stimulus and the support goes away, and we're not saying that at the end of QE2 it's going to disappear overnight, but we're saying that's the beginning of the end.
You just said there will be a collapse of commodity prices.
Absolutely, absolutely. That will happen. So
how soon?
Well, that's the hard part. So it's got the beginning of the end is when QE2 has to come to an end, and when any attempts that they do to replace this through stimulus through the back door, when it's obvious that they're not working. So to put an exact date on it is almost impossible. What we do now,
a year or two, or even
I think probably within a year from the end of June. I think that's a realistic time
oil
scale.
is now $110 a barrel. How much it can go down?
Hard to say, but we think $50 is realistic.
Really?
Yeah.
And what about the gold price? $1,500.
I think the gold also has got a slightly artificial price because of the amount of liquidity that's supported gold. So I think that expecting a gold price to go back somewhere closer to $1,000 is probably not impossible. But if it happens, and with gold, it's less clear that it will happen. But if that happens, then we would expect to see gold bounce back fairly quickly. Whereas with the price of oil, we expect it to fall back to maybe $50 a barrel, something in that region, and to remain low, to remain maybe sub $70 for quite a long time to come.
You're saying Asian economy is one of the bright spots, is that
Absolutely,
correct?
yeah. I think Asian asset prices will adjust. So I think in any big crash, expect to see stock markets in Asia fall, expect to see asset prices in Asia fall, but expect them to bounce back fairly quickly. That's the real key. So I think there could be a real buying opportunity in Asian assets if and when this
What are the reasons?
happens.
What are the fundamentals?
Well, just because fundamentally Asia is in a much different state to these indebted economies. Asia doesn't have debt. It doesn't have the problems that are impacting on growth. In America, it's almost impossible to get growth because it's being strangled by the amount of debt commitment. The same actually applies to Japan. So it's really the Asian region outside Japan that we're looking at. But if you look at the four indebted economies in the world, which are the Eurozone, Japan, the States, and the UK, we think all of these economies are going to get strangled by the amount of debt that they have. And actually that just creates real opportunities for Asia to really dominate and to become the most competitive economic bloc in the world.
So when you say Asia now, minus Japan?
Minus Japan, absolutely.
Only for short, medium term? And
it's very difficult to know how Japan is going to bounce back from the problems it has. I mean, Japan was 200% debt to GDP before the earthquake and the tsunami and the radioactive fallout. Japan has to spend a lot of money tidying up those problems, clearing up the tragedy, and Japan just doesn't have that money to spend. So that's going to push Japan into an even higher percentage of debt to GDP. That's almost certainly going to push up the cost of borrowing. Japan can't afford an increased cost of borrowing. So Japan has got a really difficult structural problem ahead, and we think it's going to take several years to unwind.
The European debt crisis.
The European debt crisis is just a disaster waiting to happen. In Europe, there's a huge amount of bad debt, which was irresponsible lending to countries that couldn't really afford this. And now there's a big argument about who's going to carry the can for that, who's going to take the liability for it. When the Irish banks all failed, the Irish government bailed them out, and now the Irish government and the Irish taxpayers don't want to do that anymore. So
is Asia alone enough to prevent a disaster of the world economy?
I think it may not prevent a disaster of the world economy, but it may prevent a disaster of Asian economy. And I think what we'll see is a lot more intra-regional trade. I think we'll see a lot more Asian consumer trade, and I think that's the way.
The Chinese outlook, in your opinion?
I think China's going to get caught up in all this maelstrom, in all this chaos that happens. But I think that China is in a very positive position from indebtedness, from surplus.
So now they have the BRICS, including South Africa, also Brazil, China, Russia.
That's what they say.
South Africa.
Absolutely. That's what they say. I think we never really understood this idea of the BRICS because it's it was four then, now five very different economies. Yeah, absolutely. India really worries us because we don't understand the policies that the authorities are pursuing in India with increasing interest rates all the time. It seems like they're determined to have a recession in India. But we think that particularly Southeast Asia, I think, the policies have been reasonably consistent. And if you look at Singapore, I think Singapore has shown a really sensible commitment to policies that are going to enable it to bounce back out of the problems that are going to be caused by the collapse of the indebted economies.
So, Mr. Paul Campbell, thank you for joining our program.
Thank you.
What's for the next break, Ong Anand?
Well, as Thai politics is hot now, as the House dissolution is coming up soon, as well as the election, we will be listening to our editors Kun Suttithayun and Kun Tun Satithaptim in Media Editors after the break.